Hi guys, welcome to another episode of Investing Leech. In this episode, we will be talking about Real Estate Investment Trust Singapore, in short known as REITs. Now, the REITs has been the talk of the town in recent years, in which investors find that it's a good avenue for them to generate passive income. Okay, in which we will now dive right into it to have a better understanding of what REITs is about. So, as mentioned in my previous episode, REITs is different from stocks in the sense that stocks is investing in a company. But when you are investing in REITs, instead of the company that you are stakeholding in, you are actually staking in the real estate, the properties that are being listed. And in the properties that are listed, there are many different types, which you can see over here, such as hotels, industrial building, shopping malls, office, or even data center. Okay, so I will not go too in depth about the different asset classes. So I will leave you on your own with the description link down below to take a look at them. So next, knowing that these are the REITs out there, how to then exactly pick on the right REITs? Okay, there are many times where people are so intrigued by the idea that a REIT can generate you a dividend yield of 10%. Does that mean that it is a good buy? I think this article written by Sid Lee on this 10 step is a very apprehensive way of analyzing and understanding what you are buying. I'm going to go through some of them. I'm going to highlight some aspect. Then I'm going to use an example later to show you how exactly to analyze a REIT. Okay, so first to look at the gross revenue and net property income. This is to look at whether the assets have been generating and earning money. If it's increasing, means that it's good. But if it's not increasing, then you got to find out why. Okay, so next, distribution per unit is where we are talking about the whether the REIT has been consistently distributing out dividend at a certain rate. Okay, you got to look through the past record and see whether these distribution are consistent. If it's not, what are the reason? And if it's increasing, is it a sustainable distribution? Okay, next, property yield between 5 to 9%. Why is this gauge given not less than 5 but not more than 9? It's because, as you know, REITs do pay out at least 90% of the taxable income, and therefore getting anything less than 5 might not be a good deal for you. Okay, and anything more than 9 might be a bit too risky if you were to look at the financial records. Okay, you got to look at specific example to understand why. Now, on the part on property yield, I would just like to talk on a point where many of my friends has been asking, hey Leech, does it mean that when the dividend yield is 12% last month is the same this month? Or is it on the point where I purchase the shares? So now I would just like to show you on this picture on the formula on how to calculate dividend yield. Okay, it's actually the annual dividend per share declared by the company and by the price in which you are buying. So let me give you this example. For example, Capital Mall Trust, example that I'm going to use later, say that it's trading at a price of $1. I enter with 1,000 shares, which equates to me spending $1,000. And the company actually declared a dividend of 10 cents, which means if I were to take the 10 cents divided by the price points per share, I will be receiving a 10% dividend yield. Correct? Say a month later, I introduced this stock to my friend. Instead of $1, the share price actually went up to $2 instead. Okay, and if she were to get the share before the X date of giving out dividends at $2 with same $1,000 1,000 shares, that will actually equate out to her spending $2,000 on the same 1,000 share stock that we have bought. Okay, but instead her dividend yield is actually halved of what I have, which is actually 5%, because I use $1,000 to get the 10-cent shares, but she used $2,000 to get the 10-cent shares as well. So instead, my dividend yield is much higher than what she has. So please pay attention, especially when you are purchasing and selecting REITs. Do not think that the dividend yield is fixed. It's based on the price point that you enter. Okay, on point number 4 on gearing ratio, you are looking at the debt. You are looking at the debt ratio of the company, whether they are borrowing a lot more to sustain the company or not. Okay, MAS actually have a regulation for REITs. Gearing ratio cannot be higher than 40%. Okay, in recent months because of COVID, MAS has actually relaxed that regulation and changing it to 45. Okay, there are REITs that are doing it higher than that, but which means that it tends to be more risky. Yeah, so you got to look and understand at what you are buying into. Okay, interest cover ratio will not be covering so much on that. Healthy portfolio occupancy rate. So for office REITs, you want to make sure that all your offices, your cubicles are being rented out. There's not much not occupied tenants. And for shopping malls as well, you want your shopping malls to be filled, and you you got to look at occupancy rate for say maybe at least 90%. That would be a good healthy rate. Okay. uh, Next will be on the present of growth prospect. Look at what the company has plans in near term to expand the REITs, and are these sustainable? Next will be price to book ratio. Now, on price to book ratio, it is a ratio driven by the current price of the REIT divided by the assets that it currently have. So if anything that is trading at a price to book ratio of 1, which means that the share price is actually fairly valued. Anything below 1 might refer it as being undervalued. Now, this is a gauge of what it currently is, but it doesn't give you a clear understanding of whether the REIT's price is actually undervalued or not. So you got to look at the other factors that I have gone through as well. Okay, so with me going through this step-by-step guide, now I'm going to show you an example. Since we have been talking about CapitaLand Mall Trust, and I think it is something that you all can relate to. Why? Because if I have to show you the names of the malls, you'll definitely be familiar with them. So if you take a look, you under CapitaLand Mall Trust, they have properties such as Junction 8, Bugis, Bukit Panjang, Tampines Mall. So it's a good mixture of heartland malls and malls in the CBD area. Okay, so if you really like this property and you think that they are doing really well, then you want to look further into what the REITs have. Okay, so in the company financial records, you can pick up a lot of things like tenancy occupants rate, who are the larger tenants, the price to book ratios, okay, and things like that. Okay, I would just like to bring you to this website on the fifth person, where they compile on the Singapore REITs data just for REITs. And if we take a look at Capital Mall Trust, okay, it's currently last trading at 210, 212 in fact. I think this is not yet updated. Okay, the distribution yield is 5.7%. So if you refer back to the step-by-step guide, okay, it actually fits our criteria of being between 5 to 9. So if it's trading at a price of 212 as of last Friday, this will be slightly lower, maybe about 5.5%. Okay, price to book ratio is at 1, means it's fairly valued at 212, sorry, 210. Okay, and the dividend per unit is 0.1197. Okay, so if you to buy it at a later price, which is higher, and your dividend distribution yield might be lower. Okay, and you have NAV. NAV stands for net asset per value. I will not go too in depth to it for today, but if you're interested, do look it out for. Okay, and gearing ratio is, as what I have mentioned before, is the how much debt the currently the company is funding. So anything below 40 is a healthy ratio. So as you can see, Capital Mall Trust has actually meet quite a few of our criterias, most of it in fact. Other than looking at company financial ratios, it's important to understand what are the growth prospect or news that has been announced that is related to the REITs that you are buying into. So if we were to look at the current plans of Capital Mall Trust, it has actually been announced that they are merging with Capital Commercial Trust. Okay, so Capital Land Mall Trust is the retail segment of the REITs, whereas Capital Commercial Trust is on the commercial, the office. So they are going to mix it in which is going to be a mix of office and retail mall, which is coming soon in a few months' time. Okay, so having this news in, you got to then understand, is this a good prospect for me? Like if I'm a REIT investment and I don't really like commercial, then would I really want to consider going in and buying into Capital Mall Trust? Okay, so all these are factors that comes into play where you really got to understand what you are buying at. Okay, and also the last thing I would like to show you is actually SGX. SGX has a feature called the Stock Screener that actually allows you to pick up many financial ratios and news that you need to look out for. So if you were to look for CapitaLand Mall Trust, okay, we can actually see many details that we'll be looking out for as well as an investor. So looking at the price chart, you can see that it has been trading at about 240, 250 to a high of 270 range before COVID. That will definitely means that the price to book ratio will be more than 1. Then in February, that is where COVID started, and in full range lockdown mode, that is where we hit to a low of say about 161. Okay, then it was fluctuating around the price point of 150 to 160 before, as we start to pick up as phase 1 is starting and circuit breaker lockdown is ending. So you see news like this do tend to affect REITs as well. As you know that Capital Mall Trust is a retail REIT. So with the lockdown, with the circuit breaker going on, there has been effect of many malls have to close down, reliefs has to be given, and to help out with tenants, with rentals and stuff. Okay, so other than that, you have your company information, financial statement, which ratio cash flow that you can look into to see that whether the balance sheets are healthy and it is a sustainable REIT to invest into, and with the relevant company announcement that you can see over here. You can sign up for this as well under the SGX app on your on your phone, where you can sign up for notification for all these announcements. In that case, you will be the first to receive any news related to the REIT to get a better sensing of what you should do with the stock that you currently have. So what I've shown you here is just an example. I'm not telling you that Capital Mall Trust is actually a good buy to go into. I think as an investor yourself, you always got to do your own due diligence, in which everyone always say it as VYODD. Yeah, to get a good idea of what you are buying in. Okay, so I hope this helps with everyone into looking at the REITs that you are interested in, and to get a good sensing and following using the step by step idea in deciding of whether the REITs is right for you or not. So that's all. Thank you all for today. I'll see you all soon next week. Bye.